Well, Wall Street is getting more bullish as the market just keeps pushing higher. The S&P 500 closing at another record high this week. It's 36th record close of the year. And our next guest raised his year-end target for the index for the second time this year. He now sees the S&P reaching 5,900 by the end of the year. Joining us now, we want to bring in John Stoltzfus. He is Oppenheimer's chief investment strategist. John, it's good to see you again. So here we are this Wednesday morning, raising your year-end target for the S&P. You now have your earnings projection to 255. I'm curious from your perspective, just what you're seeing within the market that tells you that this rally still has legs.
Well, great to be on the show, Shona. Thanks for having me. I've got to say, when we look at the scenario that's unfolding here, you continue to see resilience in the strength of of businesses, of the overall economy. The consumer, even with slowing, is still buying stuff. And services as well, even though the services numbers and the manufacturing numbers have weakened some. This is not unlikely because we've had, 11 hikes and 8 pauses, going from a band of 0 to 0.25 on the Fed funds rate to 5.25 to 5.5. And what it shows is the economy is diverse enough, strong enough, resilient enough to sustain the current rates, to allow the Fed to bring down this sticky inflation. So fundamentally, things look good for revenue and earnings growth going forward. We've already seen that third quarter, fourth quarter, and first quarter S&P 500 earnings going from 2023 to 2024. This has been good. The indication is good. It's not robust, but resilient, and that's what we like to see.
John, indeed. And so with all of this in mind, how many cuts are priced in or baked in to this new target?
Well, we would say 2 cuts, possibly, but we'll even go with no cuts if you're ready for that. We will be Fed dependent. We'll let them be data dependent. We're data dependent as well, of course. But right now, we think they've been reading the tea leaves right when they look at the economic data. We kind of doubt that we'll see a cut in September. We think that the Fed will likely want to continue to reflect its independence in a presidential election year. And with November 7th being the next date of the FOMC meeting after the September date, we'd have to say that there's room to have a little patience here.
And John, in your note, you're saying that we expect the Fed still to be able to avoid a hard landing. I'm curious, though, if they don't cut before the end of the year, what does that landing look like if we eventually are able potentially to get to that soft landing outcome?
Yeah, we think that over the course of it, we could see some increased volatility in the markets between September and November. If we get an indication from economic data that the unemployment number is hotter than expected, or that we see other slowing, other in consumer sentiment or services and business PPI. Producer price indexes. That's right. Problems there, but I really doubt it. I think the Fed is set on a likely cut in November, and we think that's a down payment for both Main Street and Wall Street, an indication by the Fed that they are genuinely coming to the end of the Fed funds hike cycle with a message of, but we're not quite there yet, but here's the down payment saying that, yeah, we're getting close to a more normalization standard here.
What is the kind of tenor that you need to hear from CEOs this earnings season to further solidify that we could get to your target?
I think what we'll need to hear, particularly, we think that the second quarter will look good, but we think it's the guidance that we want to really listen to. And what we're looking for is signs that they feel the ability to move through this period of uncertainty, okay, with how slow is the economy going to get while the Fed remains on pause. And what will support their guidance will likely be the type of products that they offer, where they are in the investment cycle within the company itself, policies of either dividends or, of course, their consumer, whether it's a business or consumers. are they feeling a need to continue to purchase what they offer, whether it's a service or a product?
John, there's been so much talk and really focus on the fact that the concentration that we're seeing play out within the market. I guess I'm curious from you, are you expecting to see wider breadth participation in the coming months? And to what extent are you not too worried about the fact that much of these market gains has just been driven by a handful of names?
You know, the handful of names has really been really from the start of this year. We were still in a process of broadening as the market expected more cuts than have actually materialized from the Fed, okay? And it narrowed, focused on the strength that was being seen within technology, particularly AI-driven names. But we believe that the broadening that we saw from the bottom that the market had last year on October 27th through now shows that we had much broader support for equities across the sectors. And now what we're seeing from the narrowing is the beginning on a day-to-day basis. There's been sort of a churn within the markets where there's a jump a few weeks ago. I think we saw 1 week where value began to outperform growth again. We've seen periods where defensives will pick up against cyclical, and then it reverts back to favoring cyclicals and favoring tech. But if I look at the from the lows in October, I mean, you had really a broad rally across the sectors led by technology, but it did not show that investors were just avoiding other sectors. And we think right now the next step is to buy the AI proxies. You just heard the report that you all were telling us about the PCs beginning to look like a good place to be as business and the consumers ramp up their PC and laptop exposure to be able to take advantage of the AI changes that are coming up. And of course, that involves cell phones as well. So you've got broadening already within tech. But the most important thing to realize is this AI is going to bring about greater efficiencies for both the consumer and business across all 11 sectors. So not just technology gaining from this. This isn't like the bubble period. And I've been in the business for 41 years, so I can remember the tech bubble. This is established technology deeply embedded in the lives of both consumers and business, and a period in which to be able to weather more dramatic times, we're able to do this with aids from technology, which is very simply AI at a lot of levels.
John Stoltzfus, who is the Oppenheimer Chief Investment Strategist. John, always a pleasure to speak with you and get some of your insights here.